right? So this is the document I will be using. And I'm teaching, this is ACCA. We call it ACCA, Advanced Financial Management. But the CPA students who are in here will be able to benefit a lot. All right? Ladies and gentlemen, you know, when we talk of finance, we shall be looking at things like how does inflation affect our cash values, right? We shall be looking at what we call compound interest, discounting, etc. Without knowing these concepts, you will never ever be able to pass any AFM paper, all right? I adjust my audio. How about now? How about now? Are you able to hear me much better? Just confirm whether you're able to hear Mwalimu. Perfect now. Great. Thank you so much. Great. Sorry for that. All right. So then we start right away. So that is the document which I'm using. And I would want, first of all, to relate this subject with what you did in high school over those many, many years. If you remember, in high school, we used to talk about compound interest. Compound interest. And the compound interest, ladies and gentlemen, this is what we used to do. If you remember, we used to say amount equals who? Are you able to remember this? In high school. Amount equals who? Somebody talk to me this morning. Somebody talk to me this morning. Amount equals, you did high school long time ago. There must be a ninja who came from high school just the day. I want to assume that. There must be a ninja who came from high school the other day. From what I'm saying, it's like there is nobody who came from high school the other day. Let me remind you, we used to say amount equals principal into 1 plus r raised to power n. Amount equals principal. So this A stands for what here? Stands for amount. And this amount for us is what we shall be calling future value. Future value. That amount is what we shall be calling future value. Then we have in this case here P, which is the principal. Principal amount, which we shall be calling present value. Present value. So remember, anytime you see this thing, FV, this stands for future value. Future value. PV stands for present value, like that. Future value and present value. Yeah. Very good. Actually, principal is an A, right? Principal, like that. So compound interest arises when interest earned each year is reinvested. This means future interest is earned on both. So remember, this subject will be able to assist AFM students, financial management students who are doing ACCA, CPA. All right? So compound interest arises when interest earned each year is reinvested. This means future interest is earned on both the original principal and the accumulated interest. We are given a very good question here. Assume an investment of 1,000 earns interest at 10% per annum for 3 years. Yeah. So if I come here, we are told, in this case here, the principal amount, we are told, the principal amount, we are told, the principal amount, good students, this is what we are told here. The principal amount, the principal is 1,000. The rate is 10% per annum compounding. Compounding. And then they are telling us that N is 3 years. N is 3 years. N is 3 years. N is 3 years. So we have here AFM, FM like that. So N is 3 years. 3 years. So you know there is this longer approach you can use. You can come and talk over year one. So year one. So year one, give me the interest. So interest will be 10% of 1,000, which gives me 100 bob. That is interest in year one. All right. So meaning that our amount at end of the year, will be our principal of 1,000 plus this 100, which gives us 1,100. Remember, we are compounding, right? Remember, we are compounding. So if you are compounding, we are not taking away our interest there. The interest will be made to be part of the principal. So that is year one. We go to year two. So year two, give me the interest. So this interest, it will be on the basis of the amount that we have at the end of year one. So 10% of 1,100. So 10% of 1,100, that gives me 100 what year? 110. So meaning that the amount we shall be having at the end of year two will be the 1,100 we began with plus 110. 1,100 that we began with plus 110. I haven't seen you guys giving me an answer, and I don't have a calculator. 1,100 plus 110. How much are we getting there? Yes. 1210. So I'm being given a figure of 1210. Then now we go to year number 3. So year number 3, give me interest. It will be 10% of what we invested at the beginning of year 3. We invested 1210 at the beginning of year 3. So 10% of 1210, this gives me 121. This gives me 121. Meaning that, ladies and gentlemen, the final amount that I will be having at the end of year 3 will be what we invested at the beginning plus what this principal has earned in year 3. So 1210 plus 121, which will end up giving us what figure? 1331. Thank you very much. So what if, for example, these years were to be like 50? If it were to be like 50, I mean, it will be very laborious to go through the entire process. It will really be chaotic. And that is why we have the formula. Yeah. And this formula, we know, ladies and gentlemen, that our amount, which in finance we shall be calling future value. Our future value will be the present value, which is the same as the principal, into 1 plus r raised to power n. So future value. Today they are investing 1,000. This is what they are investing, 1,000 today. Into 1 plus the rate of interest is 0.1. For how many years? For 3 years. For 3 years. So we have 1,000. So this will be 1,000 times 1.1 raised to power 3, which will end up giving us the what figure? So according to this student, Teresia, we are getting 1331. 1331, which is exactly equal to this. Which is exactly equal to that. So this is the first formula that I would want to really sell to you here, this formula here. This forms the base of finance. That forms the base of finance. That future value equals present value into 1 plus r raised to power what here? Power n. This is a very, very important formula. Now please listen, and listen to me very well. So if you look here, of course, they have been able to do exactly what we did, but now this brings us to a very, very important concept known as discounting. Discounting. So you can see 1,000 bob today is worth 1331 after 3 years. So if you are to get this future value of 1331 to today, 1331, yeah, from the very future, you bring it back to today, you will end up getting 1,000. So it is 1331 after 3 years, but 1,000 today. So you see now from the future coming back to today, we are discounting. The value will be smaller. You can see a discount. 1331 to what here? Somebody to 1,000. So we are saying here that discounting is the process of converting future cash flows into their present value. Discounting is the process of converting future cash flows into their present value. So when you get future values, change them to present values, then you will end up getting what we call a discounting process. Now, my good students, please listen and listen to me very carefully. The moment you understand this, you'll have picked the entire finance very, very nicely. I would still want to make reference to my formula here. So we are saying here that future value into 1 plus r raised to power n. Now, I want you to make present value the subject of the formula. Yeah, make present value the subject of the formula. So we divide both sides by 1 plus r raised to n. So then the present value will be equal to future value into 1 plus r raised to power n. Future value into 1 plus r raised to power n. It doesn't look professional. In mathematics, if you are given something like this, what is 3 over 2? 3 over 2 is the same as 1.5. But you see the same 3 over 2, I can easily take these 2 to be part of the numerator. I can take these 2 up. When I take it up, and still I'm desirous of getting the same answer, then I have to introduce what we call bar 1. If I take these 2 to be part of the numerator, no problem. It can change from denominator to become a numerator, but now you introduce what we call -1 as the power. Can somebody in this case here get out of some little trouble here and do this multiplication for me? Say there in your calculator, 3 times 2 raised to -1, please. 3 times 2 raised to -1. 3 times 2 raised to -1. Mary, thank you. You are very fast, which is very good. You are able to get 1.5, isn't it? So then we are learning something very special for finance. That this one can as well be taken to be part of the numerator. It can be taken to be part of the numerator. So it will be present value, in this case here, equals this future value times 1 plus r raised not to negative what here, somebody? Raised to -n. The present value there will be equal to future value times 1 plus who? 1 plus r raised to -n. So whenever you see us introducing this negative, we are basically sorting out this, taking this to be part of the numerator, like that. Yeah. So like now in this question, we know that our future value is 1331. Are you able to give me the present value now here, given that also r is 10%? Given that r is 10%, is there somebody who can do some abracadabra there to give me, ladies and gentlemen, to give me the present value from the formula I've just given you? Yeah, it will come back to that 1,000. It will come back to that 1,000. It will come back to that 1,000. Because this will be present value equals future value of 1331 into 1 plus R of 0.1 raised to negative. N was 3, by the way. The question we did, N was 3. So please ensure that you are able to raise yourself. If you don't raise yourself, you'll get into trouble in the future. Ensure that you are able to carry out the raising yourself, the punching of this in the calculator. So you say 1331 times 1.1, please raised. Raised in your calculators, some of your calculators, raised looks like that. Raised looks like that. Have you gotten there 1,000? 1,000? No. Okay. 1331. No. First of all, do 1331. So 1331 times 1.1. Then raised is this one here. Raised to minus 3. Just say minus 3 directly. Minus 3. Yes, equals. Yeah, 1,000. So everybody, including the students who are following me online, ensure that you are able to raise and give me feedback if you have been able to get that 1,000, Bob, by mentioning there Y for yes. Y for yes. Y for yes. Thank you very much. I hope nobody is left behind. I hope nobody is left behind. Now, my very good students, that is not how they will set this AFM for you. What they will do, they will come and give you example of present valuation. So you can see we have our future values here, all right? And then we have our years, all right? So my good students, I want us to copy down this example. We copy down this example. So we have here the year, 1, 2, 3. Then we have our cash flows. So the cash flows, you can see they are into the future. So we have 1,000, yeah, 2,000, 3,000, 3,000, 3,000, 3,000. And then they have given us cost of capital is 12%. We are required to determine present value. We are required to determine the 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 present value. Now, you're going to see by the end of our today's session, we are going to be making very serious progress in this. Somebody may think that Mwalimu has begun very low, but you'll be surprised what we shall be able to learn with these concepts here. And I'm happy because I can see online, I have 50-something students, which is very, very, very good, meaning that we can comfortably make this class a permanent class. Yeah, so that you can be doing AFM additional on Saturdays, 8 to 12. 8 to 12. For just revision here and there, it will be very, very good. Yeah, so determine the present value. Now, let me come back, my good students, here to something very special. We have just alluded to something here. We have just said that our present value equals our future value into 1 plus R raised to negative what here? N. Yes, it will be uploaded. Yes, it will be uploaded. Yes. Present value equals future value into 1 plus R raised to negative N. So this formula here has a very special meaning to us. This formula there is what we shall be calling present value interest factor. Present value interest factor, which will be 1 plus R raised to negative N. So whenever you see this one is present value interest factor. Yeah. And then, of course, R is the cost of capital. Cost of capital or required return. Required return. Which, as I shall be seeing, you cannot be given by the examiner nowadays this cost of capital directly. The examiner would want you to calculate it using, for example, CAPM, etc. So then we are learning something very, very easy here. We are saying that to get present value, to get our present value, which is our PV, we shall be taking our future values, we discount them with the PV like that. Present value equals future value times PV. You know, present value is the value at time 0. Present value is value at time 0. All these other values, like now you can see these cash flows here, they are futuristic. Now, this is really important. I would want to highlight this. Very important. I want to highlight it. Present value equals future values times PV. Now, tell us there that, have you finished writing? All right. Tell us there that there are two types of cash flows. There are two types of cash flows. We have number one, irregular, and then number two, regular. So there are two types of cash flows. Those future cash flows, we have two types here. We have what we call irregular, and then number two, we have what we call regular. Now, irregular cash flows, these ones here, they fluctuate. Yeah, these ones here are ever constant or uniform. Ever constant or uniform. So, for discounting purposes, we discount irregular cash flows using PV. So anytime we talk about irregular cash flows, we shall always discount them using what here? Using PV. So anytime we talk about, my good students, anytime we talk about irregular cash flows, which normally fluctuate, we shall always discount them using PV. And then now, good students, we shall discount regular cash flows using PV farm. Discount regular cash flows using PV farm. Discount regular cash flows using PV farm. And this PV farm, my good students, the PV farm we are talking about is present value, interest factor of an annuity. Present value, interest factor of an annuity. So, regular cash flows are also known as annuities. Regular cash flows are also known as who? Annuities. And annuities, we shall always discount them using PV for present value, interest factor of an annuity. Please listen and listen to me very carefully. Listen and listen to me very, very, very carefully. Listen and listen to me very, very carefully. Now, remember the formula of PV. PVIF is 1 plus R raised to negative what? N. PVIF is 1 plus R raised to negative N. And we normally use this for purpose of discounting irregular cash flows. We go back to our question here. So you see, if you are keen enough, you'll bear witness with me that whatever cash flows we have here are what here, somebody? They're irregular. They're fluctuating year to year. If they are irregular and they are into the future and you would want to discount them, then what do? You'll be able to come here and give us what we call PVIF. Use PVIF to discount them. And the PVIF, for sure, we know the formula. It is 1 plus R raised to negative N. We know the formula for sure for PVIF. R is the cost of capital. This COC stands for cost of capital. So then we shall talk of 1 plus 0.12. Yeah, raised to negative N, that is 1, right? Because N stands for the year 1. This year 1. So you see, 1 plus 0.12 is the same as 1.12. So 1.12, this time round raised to negative 2. 1.12 raised to negative 3, like that. So then you should be able to raise yourselves, of which I can see 0.8929, the first one. I can see the first one in your calculator there. It will be, sorry. It will be 1.12 raised to negative 1, 0.8929. So you say 1.12, second year is 0.7972. Third is 7118. All right. Yeah, great. All right. Now, ladies and gentlemen, after that, we shall be able to, for my case, create a column where now I'll be able to write discounted cash flows. I hope you've gotten all the three, eh? Have you gotten all the three? All right. So then come and give me discounted cash flows. Discounted cash flows. How do we get these discounted cash flows, which are the same as present value? You simply take the cash flows we have here times the discounting factor. Yeah. So basically, discounted cash flows are the cash flows that you have times the discounting factor. Like 1,000 times this will be 892.9. The second one, I'm told, is 992, eh? 1594. The second one is 1594.39. Thank you so much. The third one is 2135. 2135.4. Now remember that discounted factors will always be added. Discounted factors shall always be added to give us the total. So the total here is 4622.7. Is that okay? Don't make a decision on the basis of this. No. Don't make a decision on the basis of this, because this is not net present value. I'm still teaching you how to get the total present value. How to get the total present value. I'm still doing discounting present valuation. Thank Thank you very much. Now, my good students, please listen and listen to me very well. Listen and listen to me very well. Here they got 4623 because they're using what here? 3 decimal places, not 4. Fine enough. Small differences may arise depending on whether exact discounting, consistent cash flows. Consistent cash flows, these are the ones we are calling what here? Somebody annuities. Consistent cash flows are the periodic cash flows that occur regularly over time. And these consistent cash flows, they are of 2 types. Those annuities. Annuities are of 2 types. You can always make your little notes here and there. Yeah, you can make your notes. Yes. Very important. Periodic cash flows that occur regularly over time, they are of 2 types. They are of 2 types. So we have here annuity, which is equal cash flows for a finite period. 5 years, 10 years. And then we have a perpetuity, which are equal cash flows receivable forever. Equal cash flows receivable forever. Equal cash flows receivable forever. So we have annuities. Annuities years 1 to 5 or years 3 to 7, like that. So long as the period is finite. How about perpetuity? Years 1 to infinity. This one here is infinity. Infinity. Without an end in sight. Infinity. And then we have years 3 to infinity. Years 3 to infinity. Those are just examples. So these consistent or regular cash flows, we have our annuity, ladies and gentlemen, which have a finite period, and then we have perpetuity, which will be receivable forever. Present value formula for consistent cash flows. Very, very easy. Now, ladies and gentlemen, remember that our PV is 1 plus R raised to negative N. Whenever they want us to give them PV factor, what they are calling annuity factor, I'll always take 1 minus this formula of PV. So I'll take 1 minus 1 plus R raised to negative N. So I take 1 minus this formula here, and then everything to be divided by R. Everything be divided by R. Everything to be divided by R. Before I show you the perpetuity one, look at this question here. You will receive 10,000 per year for 5 years starting in year 1. The discount rate is given. They want us to calculate the present value. You will receive 10,000 per year for 5 years starting in year 1. The discount rate is 10%. They want us to calculate the present value. Very easy, ladies and gentlemen. Very easy, ladies and gentlemen. Very easy, ladies and gentlemen. So remember here, the question is, we are going to receive, in this case here, 10,000 per annum for 5 years. And then they have given us R as 10%. So remember, this will be annuity in arrears. Annuity in arrears, because you see we are going to receive this from end of year 1. is not an annuity due. I'll be coming to annuity due later. But it's important you understand that this is an annuity which is starting from time 1, not time 0. Not time 0. That's what they have told us in the question. And even if they don't tell us, we shall always be making that assumption, always. But unless they tell us here that it is starting from year 0. When it starts from year 0, we talk of annuity due. Annuity due, and the treatment will be slightly different. You see, this is going to start in year 1. So they want us to give them the present value. They want us to give them the present value. Very easy. So first of all, I'll recognize that this is an annuity cash flow. It's annual, every year. Every year. And if it is annuity, then I'm going to use PVFA. The way I've programmed my mind, even if I'm using PVFA, first of all, I will have to start with the PV formula. It's easier to remember it that way. PV formula is 1 plus R raised to negative n. Raised to negative n, that is PV. And then now I'll be able to remember that this is an annuity. And if it's an annuity, we talk of PVFA. So PVFA will be 1 minus this simple formula. 1 minus 1 plus R raised to negative n, and then everything to be divided by R. So first of all, give us this annuity factor. Our R is 10%. So our R is 10%. So it will be 1 minus 1 plus 0.1 raised to negative 5, because you see n is the number of years, raised to negative 5. Whatever answer I will be able to get there, I will come and divide everything by R alone, which is 0.1. 0.1. So I'm substituting there for R, which is 10%. You see 10% is the same as 0.1. N is 5. N is 5. Yeah. All right. So they're giving me there 3.7908. So we start with the numerator. 1 minus 1.1 raised to negative 5. 1.1 raised to negative 5 equals first, because we must handle the numerator separately. Divide by 0.1. Divided by 0.1. That's how they got that 3.7908. Thank you so much. Thank you so much. So then having gotten that, now I'll be able to get the present value. So to get the present value, I will take the future cash flows, the 10,000, only one. 10,000, then I will be able to multiply these with PVFA. I will take 10,000 times our PVFA of 3.7908, which gives me 37,908. Gives me 37,908. That is the total present value. Now please listen, because I would want you to understand this thing like crazily. If you go to an exam, you will get here 1, 2, 3. We have our cash flows, 1,000, 1,000, 1,000. Cost of capital, 10%. So you are required to give us total present value. Total present value. You are required to give us total present value. Total present value. Yes, it will be less. Thank you so much for that observation, Isaac. Yeah, you see, if you were to ignore the time value of money, you would have gotten 50K. But you see now there is what we call time value of money, which eats into this future cash flows to get present value. So it's like a discount. So then now with the, like now here, like now here, 1,000, I would have gotten 3,000. Yeah. But in terms of present value, it can't be 3,000. It'll be much less. Which reminds me, some times back here, a loaf of bread, good bread, was going for 5 shillings. Today's bread is about 100 and something, isn't it? Look at that discount if I was to move back. So total present value. So there are 2 ways of doing this. I can decide to treat these cash flows as if they're irregular. And then I discount them using PVIF. I discount them using PVIF. I am deciding to treat 1,000 as if they are very, very different and discount them using PVIF. Then this will be 1 plus 0.1 raised to negative 1. 1 plus point, that's 1.1 now. Sorry. So now this becomes 1.1. So raised to negative 2, 1.1, raised to negative 3. So is there somebody who can give me these discounting factors? Yeah, I can decide not to see the 1,000 as an annuity. I can make that decision. There's a question. I can decide 1991. That's 1.1 raised to negative 1. Negative 1, 1991. Remember, first of all, I'm getting this. I'm just getting this in isolation. 1.1 raised to negative 2, 8264. Thank you so much. 1.1 raised to negative 3, 7513. Like that. I can make that decision, yes. Yeah, so maybe a good question there. And that's why I started by mentioning that I'm just assuming first. I'm assuming that they are irregular first, and then we see whether things will work out. Have you gotten these numbers? Now come and give me discounted cash flows. Discounted cash flows, these are the cash flows I apply discounting factors to them. The first one will be 909.1. The second one will be 826.4. The third one will be 751.3. So come here and give me the total. Add them up. And then I'll be able to answer Mary. So Pauline gives me 24. 2486.8. Akma Abdi, thank you very much. Are you getting that? Yes. But you see, that kind of an assumption can only work if this period is too small, like now 3. But you see, for annuities, your examiner will give you an annuity for 50 years. Will you be able to have a very, very big table? No. So shortcut is now to use annuity factor. Use annuity factor. So this annuity factor, we are saying that present value, you only pick one number, which is 1,000 times PVIF, because it is repeating itself. So I multiply this with the present value, interest factor of an annuity. And fortunately, we know that PVIF is 1 minus 1 plus R raised to negative n, everything divided by R. Fortunately, we know that. So somebody should be able to go ahead and substitute. I can see what Mary already has. So PV for here will be 1 minus 1 plus R. Our R is 0.1 raised to negative N. Negative N, they were 3 years, remember. 3 years divided by 0.1. So that we have there, you have to move very slowly. First of all, you get the numerator. You say 1 minus, you can open brackets if you wish. 1 plus 0.1, you close brackets. You raise this to negative 3. And then you divide this by 0.1 here. You divide this by 0.1. So somebody is giving me a figure of 2.4, 2.4869. 2.4. ACCA, remember they have to be 4 decimal places. Discounting factors must be 4 decimal places. Thank you so much, Munga. Great. And now with your permission, I can go back here. So then this one will be 1,000 times my PV for here, 2.4869, which will end up giving me 2486 points. Apart from rounding off errors, this one should be exactly equal to this. They're close. The decimal is 0.1 difference. Is there somebody who has been able to learn something out of what Mwalimu has done? Yeah. Great. So this PV formula is a shortcut. It doesn't mean that you can't use the other. You can still use the older one, but the very best, whenever they are irregular, then we shall always use the PV for shortcut like that. Now, my good students, getting interesting. I told you, I'm building up a very, very big high-rise house. We began with a very good foundation. So now I want to go a step higher. Now, my good students, we have what we are calling perpetuities. Remember perpetuities? These are cash flows we shall be receiving every year without an end. Yeah, there are people who are lucky. You get, in this case here, a very old man dies and says that my grandchildren, each one of them will be getting 1 million shillings every year, for example, without specifying the period, until death maybe, right? Yeah, thank you so much, Terry. Great. So anytime they talk of perpetuity, yeah, there is something that you're supposed to learn here. Yeah, don't cram this. There is something you're supposed to learn here. Now, ladies and gentlemen, remember our normal PV fund. Our normal PV fund is 1 minus 1 plus R raised to negative N divided by R. What of a situation where N is infinity? So where N is infinity, our PV for where N is infinity will be 1 minus 1 plus R raised to negative infinity, because N is infinity, cannot be defined, divided by R. So it means that this term cannot be defined. As this infinity is becoming bigger and bigger, this term will become 0. This term cannot be defined. This term here cannot be defined. There. So we remove it. So meaning that our good students, our PV for when N is infinity will basically be equal to 1 over what here? 1 over R. When N is infinity, it will be 1 over R, PV for. So meaning that the present value when N is infinity Of course, it will be the cash flow amount times PV when n is infinity. So present value when n is infinity will be the cash flow amount times 1 over R, which will be the same as taking the cash flow amount divided by R. You don't have to really cram this. No, this process here is useless. This is a very useless process. You don't have to cram that. What you're supposed to always remember, is that to get present value, when n is infinity, you'll be taking the cash flow amount over R. You take the cash flow amount over R. You take the cash flow amount over R. Very, very important for you to be able to remember this. Like now the question that they've just given us here. The question they've just given us here. They're telling us you will receive 10,000 per year forever. Perpetuity. Perpetuity. Which is the same as infinity or infinite. Starting in year 1. Discount rate is 10%. So because it's perpetuity, then my present value here will be equal to the cash flow amount I divide by R. R which is 0.1. I don't even think present value will be the cash flow amount you divide by R. Cash flow amount you divide by R. So 10,000 divided by 0.1, which will end up giving us 100 what year? 100,000. Which will end up by giving us 100,000. Which will end up giving us 100,000. Thank you. So is that okay really? Have we mastered that concept of perpetuity? Yeah, it's quite easy. And then of course we're going to learn about perpetuity. Yeah, perpetuity due. If, for example, this was to start at time 0, what would have we done? We shall come back to that. I'm building a bigger house. I don't want to put everything, all the stones together at the same time. No, one step at a time. Now, this is now where the rubber meets the road. Where the rubber meets the road. Cash flows starting in a later year. Cash flows starting in a later year. Very, very important. We understand this. We have understood everything. When cash flows begin after a delay, first compute the value 1 period before the first cash flow, then discount it to today using the discount factor of the preceding period from the start. Doesn't make sense. It doesn't make sense. Doesn't make sense. It doesn't make sense. We normally call them deferred annuities. Deferred annuities. You will receive a good question, 10,000 per year for 5 years, but you're starting in year what? 4 and ending in year 8. You see, this cash flow, ladies and gentlemen, is not starting from year 1. Yeah, it's going to start from a later year. All right? So discount rate there is 10%. They want us to calculate the present what year? They want us to calculate the present value. They want us to calculate the present value. Now, ladies and gentlemen, how shall we be able to do this? The formula is here. You take the annual cash flows normally. You multiply this with the annuity factor, the normal annuity factor. Normal annuity factor. And then you discount, you multiply with the discount factor of the preceding period from the start, preceding period from the start. Great. 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 Do you really understand this? No, no, no. So remember, we have these cash flows from year 4, year 5, year 6, year 7, year 8. That we are going to take to get this present value, ladies and gentlemen, I'm going to take my 10,000. It's an annuity, remember. I multiply this with the PV5. The cost of capital given is 10%. And remember, I'm going to enjoy this for how many years? 5 years, no more. For 5 years. I'm going to enjoy this for 5 years. But because this is a deferred annuity, yeah, I will come and multiply it with the PV. Discounting factor is PV. We multiply this with discounting factor of the preceding period from the start, preceding period from the start. So remember, ladies and gentlemen, we are going to start here from year 4 to year 8. Preceding period is this other period here. Preceding period is this other period here. Yeah. 0, 1, 2, 3. So multiplied by the discount factor of the preceding period. From preceding period means the prior period. So in this case here, we are looking at year 3, prior period, year 3. So you multiply this with the PV at 10%. In this case here, 3 years. 3 years. This is really, we understand this, we shall be okay. And we are being told here that year 3 is used because it is the period immediately before the first cash flow in year 4. It is the preceding period. So then, my good friends, it means that I have to compute 2 things here. It means that I must compute 2 things here. Yeah, we must compute 2 things here. We have here our present value equals 10,000 times PV for first of all. Yeah, 10%, 5 years, because I'm going to receive this for 5 years. All right. But because there is time that was wasted here, remember there is time wasted. Here. We are going to start from year 4. We are going to start receiving this from year 4. So there is a vacuum. So the vacuum, I will always come and multiply this with the PV. Yeah, 10%, the preceding period. We are starting at year 4. There is a vacuum there ending at 3. All right. Now please come here and give me the PV. 10%, 3 years. PV 10%, 3 years. Give me this PV, 10%, 3 years. 10%, 3 years. So then this one here will be 1 plus R. I'll be showing you how to read the tables raised to negative n. So it will be 1 plus 0.1 raised to negative 3, which they're giving me a figure of 0.7513. Now there are students who will tell me, Mwalimu, how comes I failed this AFM 7 times? And I'm really so good at it. It's because there are things you never understood very well. Never understood some stuff very, very well. Very, very well. Like now, this is one of those things that I know many students don't take time to understand. Then give me PV5, yeah, 10%, 5 years, this one here. I know the formula. It is 1 minus this one here, 1 plus R raised to negative n, everything to be divided by R. So it will be 1 minus 1 plus 0.1 raised to negative 5, everything divided by 0.1. Which is giving me 37,908. to your decimal there. Yeah, please try calculating it yourself. That is 3.7908. It's called delayed annuities or postponed annuities. Very, very common in your exam. Hakima, remember we said 4 decimal places. 4 decimal places, always for discounting factors. 4 decimal places for discounting factors. 4 of them. Delayed annuities, postponed annuities. Use PV for 10%, 5 years. 10%. Very good. So then what do we have here at the end of the day? At the end of the day, we have our PV being equal to 10,000 times PV of 3.7908 times PV of 0.7513, which then will end up giving us what figure? Yes? You're lost somewhere, okay? Let me write this total figure, somebody. Nobody's giving me the final answer. 7,858. 27,858.28. So like now this one, don't do it partially. You come and press here 1 minus. See in brackets here we have 1.1. So 1.1, you say raise -5 equals. Let us say divided by 0.1. Give you that answer. 27,858 is wrong. 27 is supposed to be 28,480, yeah? I'm told the final answer is supposed to be 28,480. 28,480. 28,480.28. The final answer. 28,480. I'm told, please confirm. Please confirm. Please confirm that this is supposed to be 28. Please confirm that this is supposed to be 28,480. 28,480. Is that okay? It is, yeah, with some decimals, isn't it? With some decimals. Now, some students are asking there, what about this other formula? So we are told here that we shall be receiving this 10,000 from year 4 to year 8. So we have here year 1, year 2, year 3, year 4, year 5, 6, 7, 8. We shall be receiving 10,000 here, 10,000 here, 10,000 here, 10,000 there, 10,000 there. All right? So then meaning that to get this present value interest factor of an annuity, I could very easily talk of 10,000. These are 5 of them. 1, 2, 3, 4, 5. This is method 2. Method 2. So we take 10,000 times PVFA, 10%, then we have 8 years. We consider all the 8 years. All right? But you see, when you say first 8 years, you will be wrong. Why? Because you see, the first 3 years you never received anything. So you come and deduct here, present value, interest factor of an annuity, 10%, 3 years, like that. So you take PV for 10%, 8 years. This will have given you all the cash flows for the first 8 years. But you come and take away the cash flows of the first 3 years that you never received. All right? So then can somebody in this very case here give us PV for 10%, 8 years? Is there somebody who can give me that figure? PV for 10%, 8 years. Now you are experts. I can even do it offhand. 1 minus 1.1 raised to negative 8. Whatever I get, I say divided by 0.1. So according to 𝗖𝗢𝗟𝗟𝗘𝗚𝗘, 6146. 61. Ooh, 8 years, 8 years, 8 years, 8 years, 5.3350, 5.3350, 50 minus PV for 3 years. PV for 3 years. Is it 50 or 49? I don't know. Emily, I saw most of them writing 50. Yeah. 0.75, 13. 0.75, 13. It can't be 0. You see, this is PV5. Okay, mnapotea sana. This PV5, it can't be 0, my friends. It can't be 0. PV for 3 years, 2.48, 9. $2.4869. Thank you so much. Are you able to get those numbers for 8 years and 10 years? Mm-hmm. 8 years. Have you written it down? The formula. Just write down here. 1 minus 1 plus r raised to negative n over r, isn't it? Then you put 10% for r and n, you put 8. So then approximately, in this case here, approximately, they are getting 28,481. Final answer, 28,481 or 28,480, which is the same as what we got there. 1 shilling cannot make us name. 1 shilling is okay. The two methods are equally good, but later on you'll be able to see why Mwalimu was also teaching you the first one. It has a meaning. If we use gives exact, if we use great. Thank you so much. Thank you so much. Thank you so much. Thank you so much. So let me ask you a question, my good student, now. Let me ask you a question. What if, for example, I was told that the cash flow is 20,000? Yeah. 20,000, yes. Yeah. 20,000, yeah. Again, for 5 years. For 5 years. Receivable from year 9. Cost of capital is 10%. CIFA, 9 years. No. Thanks for trying, but no. So there are two ways of doing this. You could decide to do your way method. Method 1, your way. So your way, we know that we are starting this. So start period is 9. End period is 9 plus 5 minus 1. Nine plus 5 minus 1, which gives us what here? 9 plus 5 minus 1, that gives us 13. 13. You see, this approach here, so many people go wrong with it because of this reason. You see, we're going to receive this 20,000 for 5 years from year 9. So 9, 10, 11, 12, 13. So here we receive 20. Allow me to put this in thousands, 20, 20, 20. You see now these are 5, 1, 2, 3, 4, 5. If you go up to 14, you will be receiving 26 times. First of all, I would want to take feedback whether we are together up to there. That this is supposed to go up to year 13 and not year 14. So you see, we are starting from 9. We are counting 9. If I wasn't counting 9, then I would have gone to 14. That mathematics I used to count poles in high school. We are starting with 9 itself. We have, in this case here, 10, 11, 12, 13. If I do up to 13, I've taken care of the 5 years. 5 years. First of all, let's agree. How to get this end period? You take the starting period plus 5, and then you take away this 1. If you forget to take away that 1, you will not be right. Or you use your fingers to count, or come and draw this kind of a number line, and you count your 5 cash flows. So first of all, let me take feedback whether up to here we are together really. How I've done the interpretation here. Are we together first of all? Thank you so much. Now, ladies and gentlemen, here, this is what I shall do in my mathematics. So I'll come and say present value, which is the same as discounted cash flows. It will be that 20,000 into PVFA of this end period, PVFA of the upper limit. So 10%, 13 years, upper limit, minus the unwanted. Let me write again here. 20,000 into PVFA, 10%, 13 years minus PV4. If you look at, this is supposed to be PV4. If you look at this number line, where are they cutting their period? What should I deduct here? How many years should I deduct here, if you're following? You can see they're starting to count from 9. So unwanted is 8. You can see on your own, on the number line, the unwanted is 8 and below. Because the number line wants us to cut, to take 9 to 13. But when I say PV for first 13 years, I've taken away, I've taken some years which are bad. So in this case here, minus PV for 10%, 8 like that. So then take your time and compute those PV first using your calculator without writing any formula. I'll be able to see when I'll talk of 1 minus 1.1 raised to negative 13. The answer I get, I divide by 0.1. The answer I get, I divide by 0.1. And then I look for PV for, yeah. How did I get 13 years? Okay, I'll be able to explain how I got 13 years. I shall explain. Now remember, we are going to get 20,000 for how many years? For 5 years. Yeah, but this 20,000 is receivable from year 9. Cash flow, I should have spoken about 20,000 per annum every year. 20,000 per annum every year for 5 years. Receivable from year 9. So come and count your fingers. Count your fingers. Count your fingers. Count your fingers. So we are going to start from year 9. We get the first 20 there. Year 10, we get the next 20 there. Year 11, we get another 20 there. Year 12, we get another 20 there. Year 13, we get 20. You see, these are 5. They are ending at 13. But the very best way of getting this is to do it this way. You see, we know the start period. We're going to start to get this at 9. The end period, you take the 9 plus the years given, minus 1. That one pole, to count the spaces. You say 9 plus 5 minus 1. That's how I was able to get that 13. So it's either you do it manually or you use this formula to get the end. So then, are you able to give me this? Will be 20,000. What PV did you get here for 10%, 13 years? 4 point. 4 point. Or the final answer? Seven is supposed to be 7.10, 34. How about PV for 10%, 8 years? PV for 10%, 8 years, 5.3349 for decimal places. And then the final answer now is supposed to be what here? The final answer. The final answer. They're now giving me the final answer. 35, 700. Yeah, Alfred, times the 20,000. The final answer is supposed to be 35, 370. The final answer here is supposed to be 35, 370. So then I'm back. Let's continue. Let's continue. What about using the other formula? The other formula, the good thing with the other formula, and I've tested this severally, the other formula you can't confuse with this number counting. Yeah, because many students will not be able to get this 13 right. I know that. I've taught this paper for the last 20 years. I know. Of course, there are those very bright ones who will be able to get this upper limit 13, but most of us, ladies and gentlemen, we will not be able to get this. So using the other method, this is what we do. So I will come and say present value. I will come and say here, present value, the other method, method 2 now. Method 2. So present value, it will be 20,000 times PV-FA. Remember the cost of capital is 10%. I'm going to receive this for how many years? For 5 years. So if you're able to follow this second method, could you kindly tell me what am I supposed to multiply this with? If you know the second method. So there is some other thing that I must bring up for this to be complete. There is something I must bring up for the postponed, delayed cash flows. Times PV. Thank you, Mary. Yeah. Times something. Let me get it from many students. Times PV. They are talking over 8. Thank you. Thank you, Kenneth. PV, how many years? Flavia, 8. Thank you. I'm still waiting to get feedback. Remember, it's supposed to be discounting factor for the period preceding the start. For the period preceding the start. Remember, the start is not this 5, Mary. The start is 9. The period preceding the start should be 8. So PV, 10%, 8 years. Because you're starting at 9. The period preceding the start, which is 9, should be 8. Should be 8. This method 2. Because this one is so express, you simply take PV for 10% for the 5 years you'll be receiving. All right? And then you multiply this with the PV for the preceding period. So then, are you able to give me this PV for 10%? 5 years. Give me PV for 10%, 5 years. So this will be 1 minus 1.1. The rest of it is 5 all over 0.1, like that, which will end up giving me 3.7908. And then we have a PV, 10%, 8 years, which will be 1 plus R, negative 8.1, positive 8. So you should be able to know how to get PV and PV bar. 46, 65, 46, 65, like that. So therefore, so this will be 20,000 times PV for 3.7908 times 0.46, 5. Shall we end up getting an answer that is almost the same as what we got using the first method? $35,368. $35,368. And using the other method, we got 35,370. 5,370 and 35,368. So you can see the two methods are giving us the same answers. Which method do you think is straightforward? The second is straightforward, trust you me. Yeah, so I've given you the two methods. The choice now will be yours. Please feel free to ask questions. Feel free to ask questions. Method one, Bernard, at least we have one person who is saying method one. Wow, great. Method one. Great. Both of them are easy. Great. Great. And now with your permission, I'll be able to go to the next concept. The next concept is here. Ukichoka mnaniambia, once you say that you're tired, you simply get to tell me and then we take a break. They're called deferred perpetuities. Now, a very important golden rule here, golden rule for deferred cash flows. If cash flows start in year N, always multiply by a discount factor for year N minus 1. So if it is starting in year 2, the PVF will take PVF like 10% and then 1. Yeah. If the cash flow is starting in year 4, the PVF you shall use there, you know, we are taking the cash flow times the PVF, yeah, times PVF. So if this annuity is starting from year 4, this PVF will be for year 3, period preceding. Yeah, if it is starting in year 7, I will take the cash flow times PVF times PVF. But now, of course, if you're starting from the preceding year, it will be year number 6. Very, very good. Reason: the annuity or perpetuity formula gives the value for one period before the first cash flow. Therefore, the value must still be discounted back to today. No worries. Now, these are very, very important formulas that I've been able to give you there as a summary. Now, ladies and gentlemen, this is now where your exam comes from. Now, those perpetuities have growth rates. A growing perpetuity has the following characteristics. So someone tells you, I'll be giving you 20,000, but the 20,000 will be growing every year by 10%. The cash flows grow at a constant rate. Cash flows continue forever. Growth starts from year 1 or from the first relevant future cash flow, depending on the wording of the question. We start with single growth model. So single growth model, that one you must write. Single growth model, that you have to write. The single growth model, I would want us straight away to look at an example. Single growth, where we only have one growth percentage throughout. So we are given a current cash flow of 1,000. The growth rate is 5%. The cost of capital is 10%. They want us to calculate the present value. Now, ladies and gentlemen, please listen. Whenever you hear of growth rate, always remember the dividend valuation model. Dividend valuation model. And this dividend valuation model, we know that PO will always be equal to dividends, which I have to grow all over Kenya without government. Just a bad example, but to ensure that you are able to remember. Kenya minus government. This is what we call dividend valuation model, DVM, where PO stands for current market price per share. O stands for today, current market price per share. PO stands for current dividends per share. KE stands for cost of what year? Cost of equity. G stands for growth rate. This formula is only applicable whenever we have just a single growth rate. Whenever we have just a single growth rate, a single growth rate. You know, at times you'll have like two growth rates over a period. Cash flows to grow by 10%. They can also grow by, sometimes they grow at 12%, etc. So anytime you hear about growth rate, always remember what we call dividend valuation model. However, in our case, we shall not be using dividends. As here, ladies and gentlemen, we are valuing a firm. So as you are interested in getting what we call present value. So let's modify the formula a little bit. Modification. So our present value, and just even write here, the modification, the modified. So our present value will be equal to, so we have our cash flow now at time 0 into 1 plus growth rate. All over, we can't talk of cost of equity. You see, equity owners, ordinary shareholders are the only ones who get these dividends. You see, we're looking at cash flow of a firm. So with cash flow of a firm, we shall always use what we call WACC minus growth rate. WACC. So remember that WACC stands for weighted average cost of capital. So remember here we are looking for present value. So you're using the total cash flow at time 0. And total cash flow will belong to debt holders and equity holders at the same time. So then here, because it's cash flow, down here we are using what we call WACC. WACC. That's how we get present value. So remember that this CFO is cash flow at time 0. Cash flow today. Cash flow today. Cash flow at time 0. Cash flow at time 0. Cash flow at time 0. So like the question that they have just given us here, ladies and gentlemen, this question they have given us here, they are telling us there is a current cash flow of 1,000. There is a growth rate of 5%. Cost of capital is 10%. Valuation model. So if it's valuation with a growth rate, it will be present value equals cash flow at time 0 into 1 plus growth rate all over the weighted average cost of capital minus growth rate. So then remember that this is current cash flow. This is current times 0, times 0, times 0, times 0. So then the present value here will be equal to the cash flow at time 0, which is 1,000, into this single growth into 0.05, all over the cost. Of course, here they have only given us cost of capital. cost of capital. You see 10% is the same as 0.1. 10% is the same as 0.1 minus 5%, which is the same as 0.05. So present value there will be cash flow at time 0. They're giving me a figure of 21,000. 21,000. Thank you very much. Thank you very much. Thank you very much. But now you see, your examiner will behave like this. Exercise 2. So your examiner will tell you cash flow at end of year 1. Growth rate, 5%. Cost of capital, 10%. Required, determine present value. Required, determine present value. These are per annum, eh? Per annum. So one thing you're supposed to appreciate here is that this present value formula, CF at O into 1 plus growth rate, all over WACC minus growth rate. You see this, when you take CFO, CF today, you grow it, you will end up getting CF1, cash flow at time 1. Cash flow at time 1, all over WACC minus growth rate. Cash flow at time 1, all over WACC minus growth rate, like that. So please, whenever they tell you that this is cash flow at the end of year 1, don't grow it again. It's already grown. It's already grown. So in this case here, what you're supposed to do, ladies and gentlemen, is to come here and basically substitute here. So we have 1,000. Don't grow it, because this is at the end of year 1, divided by this 0.1 minus 0.05. Is there somebody who's able to give me the final answer? 20,000. 20,000. So when you're dividing using a calculator, you say 1,000 divided by open brackets, 1,000 divided by, like that. How do I know which cash flow has the examiner given me? The examiner is normally very, very lenient. ACCA examiner, KASNEB examiner, very lenient. They always give you everything, only that most students don't have time to read. See, like now here they have mentioned the word current cash flow. If it's current, it is at time O. Current is at time O. Yeah. At times they will tell you that this is what year at time. All right. Okay. Great there. All right. So, but first of all, before we break, yeah, very important. Before we break, have we understood? In this case here, I thought you guys are Gen Zs. I thought I'm the one who's supposed to get tired much earlier. I'm so happy today to realize that these Gen Zs can get tired earlier than myself. I'm happy. But have you understood this concept here of CF4 and the CF1? So we are saying here that CF1 is the same as CFO into 1 plus growth rate. So we shall take a break of exactly 30 minutes. So we shall come back at 10:30. Please, as somebody told us there, we are stretching, all of us. We are waking up. Let's move. When we come back here, everybody will be very fresh. Thank you so much. It has been a pleasure taking you through the first session. Thank you. And all of us should be able to come back. Not 10 minutes because it has to be 30 minutes because I have to take tea. I haven't taken my tea. I normally take my tea at around 10. Then I take my first meal. Yeah. All right. So I hope you shall be able to come back, all of us, and if possible, call your friends. Tell your friends we have this class which is supposed to start at 10:30. Thank you. See you then.